Hi, it's April 10, 2020. It's around noon. Today we're going to look into a little bit about bonds, investing in bonds in the current environment. This is because we've received quite a few inquiries from both clients and also from non-clients asking our views on the bond markets, especially when March itself we saw some bond markets. So basically, all aspect of the bond markets decline, some more than others. So we're going to use this episode to try and explain a little bit about how we interpret the whole situation. First, hot off the printing presses. Last night, the Federal Reserve basically announced even bigger measure, a slew of measures compared to the last time. What has happened now is that the Federal Reserve basically has put its hand into every corner of the U.S. bond market. It is not only supporting municipals, it is also going into the corporate bond markets via ETFs, and now it's announced that it will also be involved in purchasing junk bonds. So basically, the bond market now is owned by the Federal Reserve, and that basically puts what we call a floor, or at least very much allows the bond market to function a little bit more better, given the situation a month ago where it actually froze up and basically impeded companies from entering and participating in the bond markets. We need to understand that the bond market is basically the lifeline of the economy, even more so than equity markets, because a lot of companies go to the bond markets to actually try and raise money. You find even companies which are considered to be less credit-worthy, junk bonds, for example, companies issuing junk bonds. It's difficult for such companies to actually go to the stock markets because you need a certain amount of profitability at times, a track record, and even if you go into what we call the second board and so on, again, you need to have a certain kind of standing before you do so. Whereas in the bond markets, you could be a company which basically is considered to be less credit-worthy, but you enter into a segment of the bond market which is called the junk bond market or the non-investment grade, and you can still raise money. So it's very important. It's a very important market for corporations, companies, big and small, to raise money. So when that gets frozen, it basically is akin to the freezing up of the whole economy, and that's why the Federal Reserve is very sensitive to that, and that's why it's got involved in every aspect of the bond market. This is basically in the US. The scary part was the freezing of the bond market, coupled with the economic situation that resulted from COVID-19, threatened to actually sink a lot of corporate America. We have titles here, for example, S&P warns 1 in 10 US firms may default. We're talking about high yield market freezing up. So if you are already a company which is less credit worthy, typically these companies depend a lot on cash flow, and you can't go to the market to raise money, then it becomes a big issue, and the continuation of the business becomes an issue. There are and the bond market itself prior to this had its own problem with regard to size, and I'll go into that. And that's why you won't be surprised to see headlines like, for example, coronavirus may light the fuse on the unexploded bomb of corporate debt. We'll go into that. Why is it the case that this corporate debt is considered to be an unexploded bomb and such a high risk to the markets itself? These charts basically show you how the markets became so fearful of defaults in the US corporate bond market. therefore taking out what we call credit default swaps. Credit default swaps are basically instruments to insurance instruments, or instruments that insure a particular person holding a particular bond. So if I'm holding a US corporate bond XYZ, for example, and I'm afraid that this bond may default, so I go and buy a credit default swap on this particular bond. By paying a premium, I buy that particular swap. What happens is, if that bond defaults, I then get compensated for it. So basically it's like an insurance on a particular bond that you hold. And as you can see, the price of the swaps, basically the premiums that you pay in order to protect yourselves, just basically shot through the roof given the situation. So because of this, because of the increased potential defaults, what we saw was the price of insuring against the default itself had shot through the roof. The situation also has not only put pressure on corporate bonds, but also on sovereign bonds, because we've had almost every country in the world coming out with their respective fiscal packages to try and mitigate and cushion the impact from the closures, from the shutdowns that had on their respective economies. But because a lot of countries themselves are already in debt, or when they issue these very large fiscal packages, they become more burdened with debt. Then there's pressure on what we call the sovereign ratings. For example, in the UK itself, its sovereign rating was cut from AA to AA minus because of its package. In Australia, which holds one of the rare AAA ratings, its credit rating was revised. The outlook was revised actually to negative. So the ratings were kept intact at AAA, but there's something called an outlook, which is a forward-looking rating, or measure of the rating, how the rating could potentially go, which direction in, let's say, 6 to 12 to 18 months. That's called the outlook. Yeah. So that outlook was actually revised to negative, meaning to say that in the months ahead, probably the next 12, 18 months, the bias is for the ratings to go down if nothing is done to actually address some of these credit issues in terms of debt and so on. The dominoes are falling, but have yet to fall aggressively, meaning to say that we are getting to see defaults rise in the US and across the world. This basically is a report by S&P showing year to date to April, early April. The orange line is basically the number of defaults taking place. As you can see, they are basically in line with what we saw last year, pre-COVID-19. So it really hasn't accelerated, which is no surprise, because we've just entered into this particular situation. Companies will have some buffer, maybe for a month, maximum 2 months sometimes. With the additional support from the government, that probably extends it a little bit more, but we should be seeing companies starting to default maybe later this month, in May, or maybe in May onwards, as some companies, despite the fact that the government has come in and so on, they still cannot survive. So we will start to see these corporate default numbers rise in the weeks and months ahead. So this was what I was mentioning and saying about, talking to you about with regards to the worries over the corporate debt. And these are headlines taken prior to COVID-19, basically last year, basically from 2019. Things like, of course the top one is for most recent, but the bottom one, corporate debt bubble, is similar to the subprime. Excuse me. What could really sink the global economy? All these things that tell you that something was already brewing in the corporate debt markets even before COVID-19. Of course, now with the coronavirus, basically it is as the headline mentioned earlier, potentially the light that sparks the bomb or the bubble, or this is the needle that actually deflates or bursts a particular debt bubble. And we'll talk about what the debt bubble basically is. Uh, the debt bubble basically is related to the size of issuances across all the various ratings, especially those in what we call the triple B, just above the investment ratings. But if you look at what the IMF has said last year, basically they said that a shock only as severe as half of the global financial crisis would put up to 40% of total corporate debt at risk, meaning that companies will not be able to cover their payments with earnings alone. The situation had become so massive that a lot of companies were issuing debt because interest rates were low, liquidity was abundant, so they would issue actually bonds in order to get the money, right? And that money itself was either used to pay off more expensive bonds, at times and also to expand aggressively sometimes, and sometimes also to buy back their own stocks. So a lot of things that they use the money for, but in essence they had to issue a lot of bonds in order to receive that money. And at times these companies were really not that profitable. They just had enough to probably pay off the coupons on those bonds, and hopefully in the years when the maturity of those bonds came due, they would have enough to pay. But that was a latter problem, so to say. So the most immediate one is of course to pay off the coupons on the bonds, which they could do in a normal scenario. But now with the situation with COVID-19 and the way it's impacted the global economy, shutdown and stuff, a lot of these guys would just not be able, and that constitutes a default. Okay, so under here, give an example, an FT article, the coronavirus outbreak is threatening to force companies to default. There's this Evergrande, which is one of China's largest developer, owes more than 100 billion. It's issued more than 100 billion worth of bonds, and with very attractive coupons at 13%. And again, I think viewers should understand that high rates on a bond equates to what we call low ratings, or basically very low quality credit worthiness. Okay, there's always an inverse relationship. Companies that have very low credit quality need to give high interest rates in order to attract investors to park money, or at least take up their bonds. Entities which are of very high credit quality, for example governments who can pay, who seldom go bankrupt, their interest rates are very low because, again, low risk, low interest rates, high risk, high interest rates. Yeah. So again, over the years, because of the search for yield, many individuals, many institutions had flooded into these kind of high yielding corporate paper, despite the fact that the quality was very low, because historically since 2008, the massive amount of liquidities, the low interest rates, all have actually resulted in quite minimal, historically very low default rates. But now we find that the default rates are all suddenly going to spike up. Many of these people holding on to these papers have started to panic. So one of the main reasons why, or the primary reason why people in the bond markets, or people in general, are very worried about the bond markets, is because in the US itself, and it is the biggest bond market in the world, we've seen this huge amount of what we call triple B rated bonds being issued over the past couple of years. Okay, just to recap, triple B rated bonds sit one grade just above what we call investment grade. Okay, if it gets downgraded, it will go to what we call double B, which is a non-investment grade. It makes a lot of difference because, for example, some funds only can hold investment grade. If their bonds fall to non-investment grade, they would have to dispose of that bond. Also, the interest rates will start to rise up very sharply once you move into non-investment grade. So there has been a lot of issuances, as I mentioned earlier, by companies and so on. The problem with this is, basically, if you look at the US markets itself, the triple B alone is a 4.5 trillion market. Okay, whereas the junk bond non-triple B is a 2 trillion market. In any typical recession, it is estimated that 10% of triple Bs will fall, and it doesn't take a lot to move into junk status, just one notch down or even two notches down. So the 10% of triple Bs, which is about 450 billion, will fall into what we call junk status. So you can imagine that 10% of 4.5 trillion is 450 billion, and in throughout a recession, and if the recession is deeper, then of course it's not 10%, it's 15-20%. That will move into the junk markets, and the junk market itself, given that it is a smaller market compared to the triple B, just to have 450 billion fall into the junk market constitutes an increase in supply of junk bonds by 25%. And that's 10. If that's 10% moving in, if it's 20% moving in, that means it's half, almost half of the U.S. junk market supply, and that has issues that would lead to an oversupply of junk bonds. Prices would collapse, and there are a lot of repercussions to it, not only to the triple B markets but also to the non-investment grade markets. So this is really what we call a monster which has grown so big that this is the repercussion when the fallout begins. Okay, now we're going and that was just an overview of where some of the weakness in the bond market lies. The next couple of slides were intended for our Malaysian clients because we had a lot of queries from our Malaysian clients. In Malaysia, the bond market is a bit more active from the perspective that bond markets there give pretty good yields, coupons about 5, 6, 7% at times. So some of these bonds have actually declined in high single digits, and so there were a lot of queries. But anyway, the application of the factors involved not only apply to Malaysia but also apply to Singapore. So you can actually, whatever I'm going to say over the next few slides would be applicable also to our Singapore investors. Okay, so in Malaysia we kind of saw a decline in the bond markets. The equity markets, of course, if you talk about the decline from January all the way down here, that's probably about 17%. The bond market actually continued to go higher and only started to decline in early March. And if you can see, the decline was from 105 all the way to 99, so that was about 6%. Again, this is just in general, so different types of bonds would have declined in different manners. In fact, if you look into the several different types of bonds, and here what I've just taken is I've gone to this website called Fund Supermart. They do a rating on all their funds that are available there, including the bond funds. So these bond funds carry ratings from 0 to 10, but the maximum actually goes all the way up to 5. Thereafter, 6, 7, 8, 9, 10 are just equity funds. But anyway, so from here, 0 will be the most safest type of bonds, probably money markets and stuff. Then you move on to short duration bonds, corporate bonds, corporate high yield bonds, and so on. Okay, and as you can see from here, as the risk increases, the reaction of the bond markets from a 1-month performance to March 26 was actually different, because as you move up the risk scale, your bond become riskier and therefore it becomes more volatile, and this is a reflection straight away of what's happening. So the bond market isn't what we call homogeneous across. The bond market is actually made up of different types of bonds with different types of risk, and therefore different reactions when these kind of things happen. Okay, so there was still a place to hide, so to say, in the front end of the bond, where it was money market, very fixed deposit type of kind of instruments, and so on. So those that still remain above water. So when I put kind of like a name to it, not the fund names, but basically just the type of bonds: money market, high investment grade, those in the A categories, investment grades, B categories, triple B's categories. No rating constraint means that particular fund can go anywhere, whether to buy a low quality bond, high quality bond, and this is a global equivalent to it, and what we call highly concentrated, and I'll show you what that is. Again, you can see that there are different types of returns from the different types of bonds. I just want to go through each and every one of them to give you a flavor of what I think are key things that you ought to look out for when you own these type of bonds. and also to help you understand a little bit more going forward where you may want to park your money when it comes to bonds itself. So basically the first thing is the money market side. As we know, money markets are really safe in a sense of they are basically the front end fixed deposit type, high quality instruments and stuff. And you can see when you call up a money market fact sheet, a lot of triple A's, double A's, and while NR is actually non-rated, you must understand that non-rated doesn't mean it's a bad quality bond. Basically, it's just companies or even government-related entities saying that I'm issuing a short-term instrument, money market instrument. I'm not going to rate it because basically rating costs me money. It's just going to eat into my yields, into my coupons. I'll just issue it because the market knows who I am. So if you're, for example, a telecom or if you are a government-related entity, you issue without a ratings, but the market knows you and the market looks at your other ratings in your longer term bonds. Oh, it's a triple A in a longer term bond. So when it issues a shorter term bond where the risks are even less, I'm okay to assume that it's also a triple A. So don't be surprised if you have bonds which are non-rated. That's not an issue, okay? Because here in the money market fund, most of them are considered to be of high quality, okay? So it's a good thing to hold under circumstances like now. Again, it proved itself during the March sell-off. High investment grade. If you look into your bond that you're holding, the fact sheet, if you find that the majority of its holdings are in the A category and a high proportion is in triple A, government guaranteed, or even government bonds, then I think it's a safe place to be. In March, these type of bonds also suffered a bit of a sell down. You must understand that while bonds are triple A, that means structurally they are strong. What happens is the market itself could be dysfunctional temporarily. So if you had a triple A bond and you went to the market and you wanted to sell it, but just because the market froze up and there was no bids, you might be selling it 2% lower than it ought to be. So there's a mispricing in terms of what the real fundamental is and what the market is willing to accept, because there's a fear of COVID-19, because those are really technical issues that cause this 2% decline. It's not a structural issue, meaning to say the bonds remain relatively strong because they are A. Yeah? So the technical issues will go away. Yeah. So for the triple Bs, basically, again, as I mentioned, they sit right at this borderline whereby a 1-notch downgrade or 2-notch downgrade would bring them really into non-investment grade. This is where the worries start to rise because at this level, you really worry whether some of these guys will actually make it through the recession or not. And if they don't, they fall into non-investment grade, which has what we call a set of repercussions. And that's why you see a sudden decline, which is from 2% all the way now it's like -6. So there's a huge jump because the risk becomes widespread at the triple B level. Okay. Non-constrained bonds are basically funds where you give the fund manager, he or she will then look and see which are the bonds. Is the triple A good? Is the double A good? Is the triple B good? Or the single B? Whatever the case is, they go anywhere in order to try and manage and make a return for you. So these kind of bonds itself, while they're good in terms of the flexibility given to the fund manager, sometimes the bond markets, again, when it's frozen, when it's not giving a clear signal, can be confusing, and even fund managers find it difficult sometimes to make money, and they can't avoid losses, as the case here shows, because of that. And even on a global scale, you'll find that, for example, if you go in, you see there is a whole host of different types of bond ratings that you have here. So again, the danger is always at the lower end. I'm assuming that these fund managers will start to move more and more of their bond holdings up the scale, the quality scale ladder, and try and minimize this. Yeah, but again, they may still keep some low-end quality bonds because either for tactical reasons and stuff. Yeah. There are certain bonds which are highly concentrated. We know of one particular bond in Malaysia which holds only basically 2 main bonds, because these 2 main bonds actually provide very good yield on their coupons. Okay, so during the March sell-off, these 2 bonds, the prices didn't move a lot. So basically, the sell-off actually was very minimal. But however, going forward, you need to have a strong level of comfort because it's so highly concentrated that none of these two will actually default or come under duress or stress. Okay, because it's only two. If one goes, basically half of your capital goes in a sense. Okay, so this is something that you ought to look out for. And this just to give you an example of other things to look out when you open up the fact sheet of your bond fact sheet. If you find that your bond has a lot of cash, this is actually an excellent period where if a fund manager has a lot of cash, then he or she can deploy and find what we call good quality, undervalued bonds and so on and so forth. And also bonds with very low maturity or very short maturity periods. Because these will come due, the cash will be available, and then the fund manager can start to deploy it again. And of course the sectors itself. So you'll find that bonds actually are invested in different sectors. When you look at something like this, high amount is actually invested in the banking sector, which I think is quite comfortable or comforting to know. Because the banking sector today is totally different from the banking sector, let's say in 08. In 08, the banking sector was the problem. Therefore, thereafter, authorities worldwide, central banks worldwide, addressed the issue through Basel II, Basel III, separation of trading. Trading, banks were not allowed to trade; they would just have to focus on their core activities, and all these kind of measures came into place, resulting in banks now today which are very well capitalized. Okay, so if it's a well-run bank, one which is basically bigger, then I don't think you have too much to worry about. Your worry basically in a deleveraging environment, in an environment where there's an economic recession, would actually now lie with all the other sectors here. So if you're holding on to a bond in some of these other sectors, especially those which are low grade, high yield, you need to just be a bit more careful. And of course, if you are able to obtain what we call a sensitivity table from the fund manager, or the fund manager provides it, then it's good, because basically it helps to tell you what will happen to that particular bond fund if there is either increase in interest rates or even a further decline in interest rates. So currently we're in an environment whereby interest rates are expected to go down, but who knows, maybe because of the situation, inflation comes back into the picture. There's a spike in interest rates unexpectedly. So this tells you how your bond fund or bond portfolio will react to such a spike in interest rates. So for example, in this particular case, a sudden spike of 75 basis point will cause this particular bond portfolio to decline by about 3.4%. However, ceteris paribus, everything else remaining constant, over time you'll find that it actually recovers, and in 1 year's time it will actually go back into the black, so to say. Why? Because you must understand that bonds are basically you make money out of bonds, or you lose money out of bonds, basically from a few things, three things basically. One is the capital appreciation and depreciation of that bond, which is driven many a times by the increase in interest rates. Interest rates go up, bond prices come down. Interest rates go down, bond prices go up. The second one is the coupons, which are typically positive. So if you buy a bond, you receive coupons, receive coupons, receive coupons. And the third one is, of course, foreign exchange, if you're buying into a foreign bond. But if you're just buying a local bond, whether it's in Malaysia or in Singapore, and you are based in Malaysia or in Singapore respectively, you don't have foreign exchange rate risk. So basically two things: if your central bank suddenly increases interest rates, your bond basically loses value, 3.4%, given this example. However, along the coming months, you will continue to receive coupons, and that coupons helps to make up for the losses that you've made from the capital side of it. So that's why people like bonds, because basically bonds, while you may lose due to a sudden increase in interest rates, bond prices come down, as long as the coupons continue to flow in, you gradually make up for that loss. Okay, so at the end of the day, it's just a question of when you're going to make up for that loss. As long as the company still is around, still pays its coupon, eventually you would make up for that loss itself. So that's one thing why bonds are considered to be safer than equities from that perspective, because equity dividends are not guaranteed or are not compulsory. So when it comes to these kind of things, when you look at your bond fund and you suddenly find that it's dropped by 3, 4, 5, 6%. Yes, as I mentioned, over the short run, there are technical issues that cause this. Doesn't necessarily mean that your bond fund is not a good fund. It just means that the market has been a bit crazy. If you're holding on to triple A's, double A's and such, then by right, it should then be like the long term, it just continue to do pretty okay. I mean, in a sense, there will be kings like here, down, 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 but eventually it will recover, both from the perspective of being a good fund, holding good assets, and also from the perspective of what we call coupons that you continue to receive. Yeah, so don't worry too much if it's really a quality bond fund that you're holding on to. But if you're holding on to those with less quality, you need to be quite mindful. So in summary, we think that the present sell-off in the bond market is nothing to be totally afraid of. It's due to a lot of things, like margin calls, pressure to unwind positions, leverage bond positions, foreign selling and stuff. Yeah, so don't sell in a sense that if it's a good quality fund, it will make up the losses, but you should be reviewing it in case some of the funds that you're holding on to are of lower quality. So again, yes, so look for quality. I would actually look for bond funds which are rated A and above, A, double A, triple A. Those which are of triple Bs, if there's a minimal amount in the fund, fine, but if there's a huge bulk of it, you may just want to review and see whether that's something you are comfortable holding or not. We still prefer the short end. Again, short end, as I mentioned earlier, you saw the ladder. The short end was in March when all the market fell, the short end was still in positive. So that actually tells you the short end is more defensive. Some people may argue the long end in this particular environment is better because when interest rates decline, the long end interest rates go down, bond market prices go up. So the long end will go up much more than the short end. Okay, so there's an argument to go into the long end, long duration, so to say, in order to capture what we call much looser monetary policy. But there are also risks, like I mentioned. If we can't tell in this kind of really crazy environment, interest rates may suddenly swing the other way. If there is what we call a sell-off in the currency, they need to protect the currency. If there's a sudden spike in core inflation and so on. Yeah, so until the dust settles, I think parking ourselves more on the front end is something which I'm more comfortable with. And of course, you need to diversify. I worry a bit if you're holding to a single bond and if that bond is of a low quality, high yield, because again, you need to reassess whether in this kind of deleveraging environment, in this kind of environment where companies' revenues are basically non-existent sometimes, whether this company can still continue to pay its coupons, and sometimes it's not really on that company itself. Sometimes in the industry itself. Yeah, so maybe the company may be strong and stuff, but if the whole industry is not doing well and so on and so forth, so really it's an environment whereby if you're holding on to a single bond, you really need to reassure yourself that it's something which you are comfortable with. Otherwise, holding on to a basket of bonds is probably the safer alternative, because if you're holding on to a fund which holds on to 50 bonds, 20 bonds, one of them goes down, at least you've got 19 or 49 left. It doesn't impact the whole portfolio that severely. Okay, and of course, lastly, to take out one headache out of the equation is probably to stick to local currency bonds. When you start going into foreign currency, US dollar bonds and so on and so forth, of course you can make money if the US dollar strengthens, but of course you can also lose money if the US dollar weakens against the ringgit, for example. So just to take that headache out in this kind of really uncertain environment, I would stick to local currency bonds. Okay. So I hope that's given you, I know it's a bit technical and a bit long-winded in a sense, but I hope it's given you a kind of my take on the bond markets, what you should be holding, what you should be a little bit careful about, and where you should be placing yourself, front end, back end, and so on and so forth. Okay, so if you find it useful, do subscribe to our YouTube channel. If you have any more questions, please forward those questions to either your financial alliance consultant or FA advisory consultant in Malaysia. Yeah, and they will forward the questions over to me. So I hope to see you again and to come back with another video at another time. Stay safe and thank you.